You know, some ideas don't just change a business, they completely rewrite the rules for everyone. Today, we're going to dive into the story of John Bogle, a man whose one single revolutionary idea, an idea that was almost heretical at the time, ended up reshaping finance for millions of ordinary people. It's an amazing story of a rebellion that actually won and the very complex legacy it left behind.
And this quote? This was the heart of his entire philosophy. John Jack Bogle founded his company Vanguard with a radical mission. It wasn't there to serve outside owners or Wall Street suits. No, it was going to be owned by the investors themselves. And this unique structure wasn't just some gimmick. It was the engine for a low-cost revolution that put him on a collision course with the entire investment world.
To really get just how radical Bogle's idea was, we've got to go back in time. We're talking about the 1970s, and believe me, investing was a very, very different world back then.
Back then, the whole game was what's called active management. What that means is you paid some highly paid manager to pick stocks for you, and their whole job was to try and beat the market. But the problem, as Bogle saw it, was just simple math. After you factored in all the high fees, the commissions, the trading costs, these so-called experts were often failing the very people they were supposed to be helping. The whole game just felt rigged.
So Bogle's response was an idea so simple, so straightforward, that the industry literally called it un-American and a sure path to mediocrity. He just called it the Vanguard experiment.
Bogle's big idea was the index fund, and he asked a really simple question. Instead of paying someone a fortune to try and find the needle in the haystack, why not just buy the entire haystack? See, an index fund doesn't try to beat the market. Its goal is to be the market, just tracking the performance of something like the S&P 500 for the lowest possible cost.
And that's the core difference right there. Active investing is basically a bet on one manager's skill to be smarter than everyone else, and that bet comes with high fees. Bogle's passive approach? That's a bet on the market itself. It's about trusting in broad diversification and, this is the crucial part, keeping your costs so incredibly low that more of the market's return actually stays in your pocket.
But oh man, Wall Street hated it. When Bogle launched the first ever retail index fund back in 1976, it was a spectacular flop. The initial offering raised a measly $11 million. It was so bad it was widely mocked as Bogle's Folly. It really seemed like the revolution was over before it even began.
But then, slowly, something started to happen. The math just started to win. Today, that exact same fund, Bogle's Folly, now manages over $709 billion in assets. That foolish little idea had become one of the most successful financial products in history.
So how did this happen, right? How did a ridiculed experiment go on to basically democratize investing for an entire generation of people?
Well, the idea won because it offered investors 5 really clear benefits. 1, you get instant diversification across the whole market. 2, the costs are rock bottom. 3, your returns are predictable. You get what the market gets. 4, they're more tax efficient because there's not a lot of frantic trading. And 5, the whole thing is just incredibly simple and transparent. No black boxes, no secret formulas. Just own the market.
And the results of that simple appeal were just staggering. In 1995, passive funds were, just 3% of the market, a tiny little sliver. But by 2017, as you can see from this chart, they commanded nearly 40%. This wasn't just a trend, it was a fundamental shift in how America invests its money.
The impact was so profound that it even got a name, the Vanguard Effect. Vanguard's low-cost pressure forced the entire industry to lower its fees just to compete. This number right here, that's the estimated cumulative savings for investors since the year 2000, simply because indexing drove down fees for everyone. Bogle didn't just build a company, he made the whole market fair.
But this is where our story takes a really interesting turn. As Bogle's idea basically conquered the financial world, a new set of questions started popping up, and some of them came from Bogle himself. What happens when an idea becomes this successful? What are the unintended consequences?
It's a fascinating question to think about, isn't it? Can a force for good become so dominant that it actually creates a whole new set of problems that nobody ever saw coming? And here's the real kicker. Even the father of indexing himself grew worried about it. Shortly before he passed away, Bogle warned that if a few massive index fund managers, like Vanguard and its competitors, came to own huge chunks of corporate America, that concentration of power would be a really big problem.
So researchers now think this has created this powerful feedback loop. Here's how it works. As trillions of dollars flow into index funds, those funds have to automatically buy more stock in the biggest companies in the index. This constant automated demand can push the stock prices of these mega firms higher and higher, creating a cycle where the big just keep getting bigger, maybe even beyond their actual value.
And all of this has led regulators and economists to ask a vital question. Has this massive shift to passive investing introduced new, systemic risks to our entire financial system?
The Federal Reserve has actually studied this, and, well, the findings are pretty nuanced. On the one hand, passive investing has probably reduced certain risks, like the chance of a mass panic sell-off. But it has increased others. It's definitely concentrated power into just a few giant firms, and it's created new risks for more complex products that can amplify market swings, potentially making downturns even worse.
And so, this leaves us with the central paradox of John Bogle's legacy. His great democratic experiment gave the small investor a fair shake for the very first time. But in doing so, did it accidentally set the stage for a new financial order, one dominated not by Wall Street's old guard, but by a handful of passive giants? That is the question the next 50 years of investing will have to answer.